Can you start?
Okay, sir.
Okay, thank you. Right. Nalak, are you there? Nalanta?
Yes, I am there.
All right, okay. Thanks. Right. Before discussing this, I need yeah. Sudarshan, are you there? Charita? Yeah. Okay. Right. So this is a capital asset pricing model. And why we discuss this? This is important. When you value a business, we need to calculate a discount rate. And therefore, this is important capital asset pricing model. The time that we are going to spend on this is maximum 10-15 minutes, not more than that. And as you have already discussed in financial management, I don't think that we need to discuss this again, the reason. Right. So this is the capital asset pricing model. The return expected and how you calculate the risk-free rate, and we need beta, market return and risk-free rate, right? And so what is this? Yeah. Okay. Yeah, I want to share it again, I think. Right. Can you see this?
Yes.
See
Yes.
Okay. Right. So RE, as you know, return expected, or we say the minimum return required by the investors, right? So this is the return expected, or the minimum return required by the investors, right? We calculate this. We want to estimate this, right? And how you calculate this? We use one variable called risk-free rate, right? So the base is the risk-free rate, right? And this is the treasury bill rate, the treasury bond rate, and we assume that the treasury bill or the bond rate as risk-free, right? And so any investor can invest in treasury bills or treasury bonds if you have money, and you can get a guaranteed return of the T-bill rate, and therefore we treat treasury bill or treasury bond rate as risk-free rate, right? And we assume that no default risk in treasury bills and treasury bond rate. So assuming that only, we consider government treasury bill or bond rate as the risk-free rate, right? So that's the base. Any investor can invest in government treasury bills, and they can earn treasury bill rate, right? So that's the risk-free rate. No default risk, you can invest in treasury bills and earn this return, right? So this part, right? So this part is called risk premium, right? How you calculate return required or return expected, risk-free rate plus risk premium, right? So the logic behind this model is, any logical investor won't take an additional risk without a return, right? If you invest in a company, let's say commercial bank, right? you need a higher return than the treasury bill rate. If you want to invest in HNB, you need a higher return than treasury bill rate, right? And if you want to invest in, let's say, Union Bank, again, you need a return. Varies from investment to investment based on the risk of the investment, right? Based on the risk of the investment, right? If the investor think that Union Bank risk is higher than commercial bank, the Union Bank investors, they need a higher return than HNB, right? And the treasury bill investors and HNB investors, if you compare, HNB investors need a higher return than treasury bill rate, right? Why? HNB investment in HNB, there's a higher risk, right? And compared to HNB, if Union Bank risk is higher, the investors need a higher return than HNB to invest in Union Bank, right? So the additional premium required, we calculate from this part, right? We calculate from this part, right? How you calculate? This is beta, right? Beta value. And so measure of the target company's risk against the market risk, right? And the beta is used to measure systematic risk or the unsystematic risk. As you all know, as you all have already discussed this in financial management, you all know, right? There are two types of risk, systematic and unsystematic risk. And beta is used to measure systematic, unsystematic, or both. Huh? Beta is used to measure. Yeah, before that, what's the difference between systematic and unsystematic risk? The difference between systematic and unsystematic risk?
The systematic risk, like which is known to which is uncontrollable, like for like inflation, fluctuation in this is across the board, all
Exactly.
industries.
Yes.
Industries are, yeah.
Yes.
Apply for
Right?
all industries.
So when you say, yeah, when we say systematic risk, right? Another term for systematic risk is market-wide risk. Market-wide risk. So the companies operating in the market, all the companies are affected due to these kind of risk, right? Examples for systematic risk: inflation, exchange rate risk, interest rate risk,
political instability.
Yeah, yes, political instability, right? And weather conditions, right? All these things are affected by the companies in that market. So therefore, we call these kind of risk are called market-wide risk or systematic risk. Then there are other types of risk called unsystematic risk, or we call it company-specific risk. Company-specific risk. What are the examples for company-specific risk?
The credit risk.
Yeah, credit risk.
Labor turnover.
Any other?
Labor turnover risk.
Labor turnover. Yeah, labor turnover.
Technological risk, like cyber attacks and all.
Yes, yes. So whatever the risk
specific for this particular
yeah
user.
specific for a company calls unsystematic risk, right? Let's say labor issues, right? So specific to a particular institute. Trade union actions. If it is specific to a particular industry or the particular company, it's an industry specific risk, right? So high labor turnover, as we said, right? And if it is applicable to one specific company, so these are the company specific risk, right? Strikes. So therefore, in finance, we categorize systematic and unsystematic risk. And also in finance, we say, if we maintain a well-diversified portfolio, right, we can minimize
Unsystematic risk.
Unsystematic risk. Company-specific risk, right? How you minimize company-specific risk having a diversified portfolio, right? So one such risk is weather conditions, right? The rainfall. And the rainfall is affected to all the companies in the market, right? But if you maintain a diversified portfolio, right, and rainfall is good for one business and bad for another business, right? Rather than investing everything in one business, if you maintain a portfolio, you can reduce the risk, right? And if there are geographical specific risk, right? So let's say COVID and tourism, right? And let's say the countries which control their COVID pandemic, so there's a potential for them. And in Sri Lanka, if the number of cases reported daily, if it is more than 900, I think there will be potential travel restrictions from countries like UK, right? So tourism just started, and whatever the political situation, these days, situation is not good to have gatherings like these strikes and other the political campaigns. So these days it's not good. Why we say the tourism industry after 2 years, now they get business. Now most of the hotels the occupancy increased to 40%, 50% level, and started picking up from October. This is the second month, right? So there's increases above let's say above 900. So there can be potential travel restrictions from UK, USA, right? So again, negative impact to the leisure sector. So therefore, it's not good, right? So even if you invest in the same sector, and you can geographically diversify, right? When Easter Sunday attack is there in Sri Lanka, it's the opportunity for Maldivian hotels. So therefore, companies in Sri Lanka, so those who have hotels in Maldives, so they can get some kind of return from the Maldives market, right? So therefore, we can diversify, or we can maintain a well-diversified portfolio and minimize risk of the business, the portfolio, right? And the beta is used to measure which kind of risk, systematic or unsystematic?
Systematic risk.
Systematic risk. Remember this, beta is used to measure systematic risk, not company specific risk. Market-wide risk, right? And remember, the beta is used to measure systematic risk. And how you interpret beta? the volatility of a return of a company compared to the overall market. Compared to the overall market, right? If the overall market return increases by 10%, so what will happen to this company share return, right? So if the volatility is higher than the market, the fluctuations are higher than the market, so then the beta value is higher. We say the market beta or beta value of the entire market is 1, right? If the volatility is more than the market, beta value should be more than 1, right? Is it clear? So beta is used to measure volatility of a return, the return of a company, right? Let's say if we calculate HNB beta value, right? So it measures the volatility of HNB return against the market overall market return. If the HNB share volatile return, the volatility is higher than the market. If the HNB is, the volatility of return is lower than the market, the beta should be lower than, less than 1, right? Is it clear?
Yeah.
Right. So as you have discussed in finance, this is easy. And also the meaning of return of market, if you maintain a portfolio similar to the market portfolio, the return that you could earn is the market return, right? Return of the market. How you calculate the market return in finance, FM? How you calculate the market return? Not discuss, right? We can use there are a number of indices. There are index, all share price index, S&P index. So we can use one of these index to calculate the market return, right? So it's a reflection of the overall market if it is all share price index, right? So we take the index as at today, and in 1 year's time, the difference is the return, right? So we can take the market indices to calculate the return, market return. And I'm not going to complicate this. There are different ways to calculate return, but just say based on the indexes or indices we can calculate the return, right? If you take all share price index, and the growth in all share price index is the return that you can get from the share market, right? So the difference between, please try to understand these two, RM and RF. So here, this part without beta, so this is called market risk premium. So this part is called market risk premium, the return of market minus risk-free rate is the market premium. So if you multiply market premium by beta, you get the risk premium. Right. And there's an example. Can you do this? You need to calculate the expected return of the stock based on the capital asset pricing model formula. Right? You know the formula. This one. Right? Use this one to calculate return required or return expected. Yeah, I will give you 5 minutes. ලාම් එක තියලා නිදාගෙනද නෑ නේද? ඉස්සර physical class in ඔස්සේ හිටියා one of the pharmaceutical companies head of marketing, right? නම කිව්වොත් මම හිතනවා ඔයාලා දන්නවා. ඒ නිසා මම I'm not going to tell you. lecture එක පටන් ගන්නකොට නිින්ද යනවා. ඊට පස්සේ let's have a break කියපු ගමන් හැරෙනවා. ඊට පස්සේ break එක ඉවරලා ආපහු පටන් ගන්නකොට ආයෙ නිින්ද යනවා. ක්ලාස් එක ඉවර කරනකොට ආයෙ නැගිටිනවා. Yeah. තව අපේ යාළුවෙක් හිටියා sometime back we work together. He's also a lecturer called Deepal Perera, and meet එක පටන් ගන්නකොටම හැමදාම නිින්ද යනවා. drive කරන්නේ වතුර බෝතල ළඟ තියාගෙන ඔළුවට වතුර දාගෙන. Done? What's the answer?
9.5.
9.5. Nalaka, is that correct? 9.5? Or you got a different answer? Okay, let's use the Excel sheet, then it's easy for me.
I got
8.5. Okay. Can you see the Excel sheet?
Yes.
Yeah, right. So let's calculate. This is the formula, right? Return required, risk-free rate, beta, market return, and risk-free rate. And what's the risk-free rate? RF?
3%, right?
RF 3%. Yeah, 3%. It's 3%. And beta value
1.3.
1.3.
is given, right?
Yes.
Yeah.
1.3. And then market return.
8%.
Yeah. So yeah, let me before using Excel sheet, I want to use the presentation again. Right. So imagine an investor is contemplating a stock worth 100 per share today that pays a 3% annual dividend. Right. This company pay 3% annual dividend. The stock has a beta compared to the market of 1.3. The beta value is 1.3. Also assume that the risk-free rate is 3%. The risk-free rate is 3%. And the investor expects the market to rise in value by 8% per year. What is this? This investor expects the market to rise in value by 8% per year.
8%.
Market return.
Market return. So this 8% is market risk return. This is 3% is RF, and this is beta.
Yes.
Yeah. So calculate the expected return of the stock based on the CAPM formula, right? And we know the beta is 1.3 and 3% is the risk-free rate.
Risk-free.
In the market rate. Yes. Yeah. Right. Let's use this formula, right? And right. We want to calculate this. Right. So risk-free rate is 3%. Right. You can put 0.03 plus
1.3.
yes. Beta value
1.2.
1.2.
3.
1.3, yeah. 1.3. And again, market return.
0.08.
Yeah, 0.08 minus
0.03.
9.5%.
yes. Right. The answer is
9.5.
yeah, 9.5%. Nine point five. Right. Right. Now we are going to discuss the cash flow based valuation. Can you see the PowerPoint presentation?
Yes.
Right. So we are going to discuss discounted cash flow methods. So under that, we can discuss dividend or earnings or free cash flow method. Right. We can discuss dividends, earnings, or free cash flow methods. Right. Dividend method. Again, I'm going to use the Excel sheet, then it's easy for me. Right. Can you see the Excel sheet?
Yes.
Can,
Yes.
okay. Right. So before discussing this, I am going to explain you different type of cash flows, right? So this is cash flows, right? And this is year 1, and this is year 2, year 3, year 4, year 5, and you get this cash flow indefinitely, right? So thereafter you get the cash flow every year, right? Let's say first year you get 5 rupees, second year also you get 5 rupees, third year also you get 5 rupees, fourth year 5 rupees. So indefinitely every year you get 5 rupees as the cash inflow, right? There's an investment. If you invest in this company or invest in this investment, you can get 5 rupees every year, right? How do you calculate the present value of all these cash flows? In finance, how do you calculate the present value of this cash flow? Right? If you get a constant amount every year indefinitely, how would you calculate the present value in finance? I think second week you discuss this in financial management, right? So how you calculate? We need to divide the annual cash flow by the discount rate. Is it clear?
Yes.
Yes. So if we get a constant amount of money every year indefinitely, to calculate the present value, we use this formula. So this is called present value of a this kind of a cash flow is called a perpetuity, right? So this is present value of a perpetuity, right? So if you get a cash flow every year indefinitely, so how you calculate the present value? Cash flow divided by the discount rate, right? Hope you discussed this, right?
Yeah.
Yes. Okay. So then let's assume that without mentioning cash flows, let's say this is the dividend. If you get a dividend every year, 5 rupees every year, right, indefinitely, so you need to calculate the value of the share. How you calculate the value of the share? The dividend that you are expecting in future, you need to discount by the discount rate. So then you can calculate the value of the share. So formula, I hope you use P0 to calculate the value of the share.
Yeah.
And yeah, so dividend divided by
R.
Yes, right? So if the dividend is a constant amount every year, so this is how you calculate the value of the share, right? It's same as the present value of a perpetuity, right? So assume that dividend is a perpetuity, you get a fixed amount, no growth, and in this situation, the growth rate is, we assume that
0.
Right? So this is one dividend valuation formula, right? So this is one of the dividend valuation formula. Share price, P0 is share price. How you calculate? If you know the dividend, you need to divide it by the discount rate, right? in this kind of situation, do we need to use the first year dividend or second year dividend or year zero
No.
dividend?
No.
Which year
We can
dividend we
just-
need to take?
We can just take the dividend of D0 and divide by the GR,
Okay.
because all are equal, right?
Yes, right. So you need to understand, as there is no growth rate, the amount is constant, right? You can take any dividend, whether year 0, 1 or 2 or 3, you can take any number. Why? So all the years dividend is 5 rupees, right? Therefore, you don't need to mention here D0 or D1 or D2, right? So here you get a constant dividend. Right? So if you get a constant dividend, this is the formula. Right? Second type of cash flows. Next example I'm going to take. So this is the cash flow. I'm going to calculate so this is year 1 and year 2, year 3, year 4, 5, and so you get the cash flow indefinitely. So first year cash flow is 10 rupees. Second year cash flow, right? How you get? There's a 10% growth, or let's say 5% growth. So second year dividend, how you calculate? First year dividend into 1.05. If there's a not 5. Right? So if the growth rate is 5%, right? So if you calculate the growth, the first year growth rate is 5%. Right? And you can calculate the second year growth rate also. Second year, third year growth rate. And again, next year also growth rate 5%. So then your dividend for third year, how you calculate? 10.5 into
1.05.
1.05, right? 11.03. So how you calculate the next year dividend, fourth year dividend? Again, last year dividend into 1.05. Because the growth rate is, all these years growth rate is 5%. Fifth year also, how you calculate? Take last year dividend into 1.05, 5% growth, right? So if you continue this cash flow, right? And if you receive this kind of a cash flow with a constant growth rate, right? So this is a cash flow with a constant growth rate. Cash flow with a constant growth rate. What's the growth rate? Every year?
5%.
5%. The growth rate is 5%. And if you get this kind of a cash flow indefinitely, how do you calculate the present value? Present value. How do you calculate the present value? Right? Cash flow 1 divided by R minus G. Right? So this is the formula. Basic mathematics in finance. Yes. So if the cash flow with a constant growth rate, every year cash flow grows at the rate of 5%. Right? And you can use this model to calculate value of a share. If the dividend grows at a constant growth rate, right? The formula is, instead of cash flows, we take dividend 1. Let's say dividend 1 divided by
R minus G.
R minus G. So this is the formula. This is called Gordon's dividend growth model. Right? The same formula, right? You can customize, or let's say this is D0, D1. How you can calculate?
D0.
Yes. D0.
1 plus
1 plus
G.
G. Right? Yeah. I'm going to explain this is an example, then it's not that difficult. R minus G. Right? Why? Both the formulas are same. The reason is to calculate D1, dividend 1, next year dividend, right? So you need to multiply D0 by 1 plus G. So therefore, instead of D1, we can use this part. Right? Any questions? Right? Okay. Right. Now, yeah, any clarification you need? So first example here, a dividend with a constant amount of cash. Or if the dividend is a constant amount, 5 rupees every year, 10 rupees every year, 20 rupees every year, right? So you need to use this formula, dividend divided by the discount rate. And if there is a constant growth rate, you can use this one or this formula, the same formula with a little different, right? And let's say some companies are there. So if it is a, let's say, a new industry or a new company, and first few years you can earn a large amount of or higher growth rate. Thereafter, first 5 years a higher growth rate, thereafter the constant growth rate. So we call it multi-stage growth, right? So sometimes let's say first 3 years one rate, then the next 2 years another rate. So after 5th year, a constant rate. So if you get that kind of a cash flow, again you can calculate the present value, right? Present value of the cash flows. Okay. Right. So we discussed this. Can you see the PowerPoint presentation?
Yes.
Yeah. And we discussed this also. And instead of dividends, you can use earnings also, right? Some companies are there, they don't pay dividends. So then you can use earnings instead of dividends. The same thing, only difference is earnings. Instead of dividend, we take earnings. Then finally, we want to discuss the free cash flow method. So how we calculate the value, the present value of future free cash flows, right? And I'm going to discuss this. Okay, right. There are 2 or 3 examples. Can you do the first question? Please do the first question. company X paid a dividend of 1.8 per share this year. The company expects dividend to grow in perpetuity at 5% per year, and the company cost of equity is 7%. The 1.8 dividend is the dividend for this year. Please calculate the value of the share. What's the value?
20.
20. Any different answer?
Yeah, I got a 90.
90.
I
Okay.
also got 90.
Yeah.
Yeah.
So then we'll get the average.
But this is perpetuity with the constant. There is no growth. That is
Yeah.
just divided by the.
No growth?
Oh, okay. Constant growth at 5%, no?
Yeah.
Then
Yeah.
it's 90. Then it's
Yeah.
90.
The company expect dividend to grow in perpetuity at 5% per year,
Okay.
right? So the growth rate
It's
is
90.
5%. Yes. Yeah,
Then
let's
it's 90.
see. Yeah, let's see. Right. And I want you to read the question carefully. The company X paid a dividend of 1.8. This is D1 or D0?
D0.
1.8 is D1 or D0?
D0. It's paid.
Yes, it's paid. If it is already paid, you can't take as the expected dividend or the next year dividend, right? So let's do this. Right. You need to use this formula. This one. Let me use a different color. Right. So D1, you need to find D1. Can you see the Excel sheet?
Yes.
D1, you need to find the D0 is
180.
1 plus G. Right. And yeah.
In the
So-
question, it is given that 180
Yeah.
is for this year, no? Which means that it is D1, isn't it?
Yeah, no.
This
The-
paid, right?
Already paid, right? Already paid. Read the first sentence.
No, but the second sentence is saying that it is this year.
This year,
If you read,
yeah.
if you read it carefully.
Yeah,
it
this
says
year
it is
paid.
this year.
Already paid.
Okay.
Paid
Right.
means D0, right?
Yes. Yeah. So
Okay.
1.8, right? 1 plus G is growth rate is
0.05.
yes. Is the formula. Right. So dividend one is 1.8, 1.89. So this is D1. And the growth rate is, we know, is 5%, 0.5. And R, discount rate,
0.07.
yes, is 7%. Right, now we can calculate the price. Dividend 1, 1.89. This one. Divided by R is 7% minus growth rate is 5%. 94.5, right?
Yeah, right.
Yeah. So this is the answer. So this is the answer. Share price 94.5. Any questions? Any clarification? These are not difficult questions, right? Right. Second question. This is a difficult question. Not difficult if you understand the basics. A company's dividend. Can you see the PowerPoint presentation? Question 2.
Yes.
A company's dividend payments to its shareholders over the last 5 years. Year 2001, $1, 2, 1.05, 3, 1.07, year 2004, 1.11, and 2005, 1.15. Calculate the share price if cost of equity is 8%. If the cost of equity is 8%, calculate the share price. I will give you 5 minutes. What's the answer? Yeah. Right. Not it done? Okay, to save time, let's do this. A company's dividend payments to its shareholders over the last 5 years. So this is historical dividends or future dividends?
Historical.
Historical. Yeah. Can you take the present value of these, all these dividends and calculate the present value? No.
No.
All these are historical dividends, right? So dividend already paid, right? So therefore, how we are going to calculate this? You need to estimate the dividend growth rate, right? Based on the historical dividends, you need to estimate the dividend growth rate, right? So you need to assume that the dividend grows at a constant rate and less fluctuations. First year 1, thereafter 1.05, 1.07, 1.11, 1.15. So there's a kind of a constant growth, right? So therefore, you can calculate the compounded annual growth rate, right? You can calculate the compounded annual growth rate. Now do it.
Yeah. That came to 3.5%.
Sorry?
Came to 3.5%.
Okay, 3.5%. Is that correct?
I hope so.
Okay, yeah, let's see. Let's see. Yeah. Okay. So 2001, the dividend is 1 rupee, $1. Right? I want to use the Excel sheet. Right. So this is year. Let's say this is 2001, 2002, or 22, or whatever. 2003, 2004, 5. Right. I think 5 years data given. And first year 1. So the dividend, first year 1. Second year
1.05.
1.05. Third year
1.07. 07.
Yeah. Fourth year 1.15, right?
11.
11. And 1.15.
15.
Yes. So this is historical dividend payments. And though I typed all these numbers, you don't need this. And to calculate this dividend 1.15, and you should be able to calculate. So if you know the growth rate, and you can use 2001 dividend and calculate 2005 dividend. So how you calculate dividend 2005 you want to calculate. How you calculate dividend 1 plus G how
To
many
the
years?
power,
To the power
4 years. 4.
4 years, yes. 4 years. Why we say 4 years, right? If you calculate the growth, first year to second year growth rate, let's say G1. And second year to third year growth rate, G2. Third year to fourth year, G4. Fourth year to fifth year, sorry, this is G3.
G3.
Yeah. And this is G4. So therefore, growth rate is, N is 4 years. Right? Here 4 years. So this is 4, not 5. And now you know the numbers, right? 2005 dividend 1.15. And this is first year dividend 1. So bracket 1 plus G we don't know. Sorry. So this is the formula. From this formula, you can derive G. Or if you are using scientific calculator, you can calculate the growth rate. What's the growth rate? What's the growth rate?
3.5. Okay.
3.5, right? Hope you know how to use the scientific calculator and calculate.
3.5.
Yeah. Sorry? What's the rate? 3.5, right? You can use your calculator and calculate. You don't need to calculate like this. Right. 3.5. So therefore, you can calculate D1. Right? Or next year dividend. How we are going to calculate this? This is D1. Right? 1.15 1.15 1 plus growth
G.
rate is
3.
yeah G. So therefore the dividend 1 is 1.15 into 1.035. So this is D1. Now you can calculate the price. Share price. D1 R minus G. Dividend 1, we calculated this one. And R discount rate 8%, right? 8%,
Yes.
right?
Yeah.
8%. Yeah. Not 8.
Is the D1 correct?
D1.
Because it has to be 1. Yeah, 1 plus 0.35. No.
Yeah,
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 the-
yeah.
The
Okay,
answer
okay.
right, but the formula is wrong.
Yeah. Here, this is not. Yeah, 3.5. Yeah. Thank you, Lakshman. 3.5. Answer is correct, right?
Yes, yes. Answer is correct.
Yeah. So I calculate this number. I just typed here. Right. So R minus G is 0.8 minus. Therefore, the answer is 39, right? Answer is 39, right? So this is the answer.
There also you put the G wrong, no?
Yes.
Sorry?
G is wrong, no?
26.4 it came because 0.8 minus 0.035.
Yeah.
Yeah. Again, I made the same mistake. Yeah. Okay. Right.
Huh?
Right.
Uh,
Any? Yeah.
I got 26.45, no?
It's correct.
What's the answer?
26.45.
Yeah.
Yeah. This difference between the 0.8 and 0.35, right?
Yes.
Yeah. Okay. Yeah. Let me. It's minus. Yeah. This answer. So here also I use 5 instead of 0.35. Growth rate is this. Right. Just apply. Now you know all these numbers. The application of numbers. 26.45. Any other questions? Any other? Right. And there's one more question. Do it as a homework. Right. And it's a multi-stage. If you have a stock which pays 1.45 dividend, which is expected to grow at 15% for 4 years, then at a constant rate of 6% into the future, the discount rate is 11%. Estimate the share price. Right. So I'm not going to do this. I'm not going to do this, and you can do it. Right. And I want to discuss this question, the free cash flows to equity. And yeah, let me copy this right? And before discussing this, I want to use the Excel sheet, then it's easy for me. And yeah, hope you can see the Excel sheet.
Yes.
Okay, right. Now I want to calculate cash flow from operations, right? I discussed several times saying that this is important. How you calculate cash flow from operations? We take profits, then first adjustment, plus or minus non-cash items, right? Then plus or minus working capital changes, right? Working capital changes. So this is how we calculate, sorry. Right. So how you calculate profit plus or minus non-cash items, working capital changes, right? And I'm going to extend the same formula to calculate the free cash flows, right? Free cash flows to equity. We are going to calculate free cash flows to equity. The meaning is the cash flows freely available for equity holders, right? So these are the cash flows freely available for equity holders, right? And first you need to calculate the operating cash flow. And we discussed this several times, how to calculate the operating cash flow. The second week or the third week, at the beginning, we discussed how to calculate the free cash flow using direct and indirect method. So this is indirect method. The profit. First, you need to make adjustments for non-cash items such as depreciation, amortization, or if it is already deducted, you need to add it back. If it is already added, you need to deduct it, right? Non-cash items. Then second one is working capital changes, right? And so if there is an increase in working capital, we need to invest. It's a cash outflow, right? So therefore, by doing that, we calculate the cash flow freely available for the operating cash flow, right? Now we are going to extend this further, right? We are going to combine, this is operating cash flow, investing cash flows, and financing cash flows, right? So we are going to combine operating cash flow to investing cash flows and financing cash flows, right? So let me use the again PowerPoint presentation, right? So this is, can you see the presentation? Can you see the PowerPoint presentation?
Not yet.
Not yet. Yeah, now good.
Okay, yeah. So this is net income, net profits, right? Can you see net profit?
Yes.
Then you add back depreciation. Add back depreciation. Why you add back amortization? These are
None.
non-cash, right? Depreciation and amortization, you add back non-cash items, right? So forget about the next item. Then deduct change in working capital. Let's assume that this is an increase in working capital. If there is an increase in working capital, we need to deduct, right? All these highlighted items are used to calculate operating cash flow, right? Investing, capital expenditure, right? To run your business, yeah, let me use a different color, then it's easy, I think, right? Right. So net capital expenditure, this one, right? Net capital expenditure. So this is investment in property, plant and equipment or any other investments. Investment in fixed deposits, investment in property, plant and equipment, investment in treasury bills, bonds, all the investing cash flows are called capital expenditure, right? You need to buy plant, machineries, right? So this is investing capital expenditure, the capital expenditure. The last two parts, this is financing. New debt issued, new borrowings, or debt repayment, right? This is financing. Right? So from your profit or operating cash flow, you need to set aside some amount for capital expenditure, and also you need to set aside some amount for debt repayment. So the remaining amount is the cash flow freely available for the equity holders. So this is called free cash flows to equity, right? Right. So we'll discuss this in detail next week. And yeah, so any questions from, I'm going to repeat this, right? This is not difficult. And we discuss operating cash flow, and why I emphasize this, right? So most of the business valuations carried out in Sri Lanka and other countries, so this is very popular, right? So most popular method is free cash flows. Therefore, the most of the companies use free cash flows to value their business. And if you get a valuation report, 90% of the, let's say more than 90%, most of the valuers use free cash flows as one of the valuation options. If you understand this, so it's useful for you. And yeah, so now it's 9:33. Let's any questions? Otherwise we can stop. Right. So try to understand this. If you can't remember this, just look at the operating cash flow calculations that we discussed in the second week or the third week, right? We took one example and recorded 15 transactions. And from the transactions, we prepared the income statement, balance sheet, and the cash flow statement. And when we discuss the cash flow statement, we discuss how to calculate the operating cash flow using indirect method. So this is operating cash flow other than the things we colored in blue color, right? So the all highlighted items are required to calculate operating cash flow. So this is the investing and financing. So after deducting all these things from your net income, the amount available is the amount available for the equity holders. You need to do these calculations every year and discount by the discount rate, then you get the value of equity, right? Okay, with that, let's stop. I am also tired. Right.
Thank you.
Thank you, sir.
Thank you. Good night.
Sir.
Good night, sir.
Good night.
Good night.
Good night.
Night.